Hello everybody to our webinar on performance of alternative investments. My name is Michel and I'm the Managing Director of LPX and will guide you through the webinar today. It will last about 45 minutes because we have three asset classes that we would like to cover with you. That's private equity, infrastructure and private debt. We launched the very first private equity index in 2004, measuring the risk and return characteristics of private equity index. In 2007, we launched also infrastructure indices that measure the performance of infrastructure stocks. And a couple of years ago, we also launched and started analyzing private debt companies. So that are companies that provide debt capital to unquoted companies. All those three asset classes are branded as alternative investments. However, when you look at the underlying risk and return characteristics, you will see that there are significant differences. So it's really important to understand the characteristics when it comes to those three asset classes, because an investor should understand what can he expect from a risk and return characteristics. So when we look at the current year, 2023, we already see significant differences. Here you see those three asset classes. The blue line shows you the performance of private equity investments. The orange line, the performance of private debt investments, and the green line, the return of infrastructure investments in 2023. And as you can see, private equity had a return of around 21% year to date. However, and I will come to that later in the presentation, when you look at the underlying subsegments of private equity, for example, buyout and venture, you will see significant differences again in those subsegments. Infrastructure has had a return of -6% year to date, and this is mainly due to the fact that many investors are switching their asset allocation and are now more investing into bonds because they get now a return of 5% in US dollars. So many decrease then the allocation for infrastructure and increase instead of that the allocation to bonds. So it has nothing to do with the underlying economics of infrastructure investments. It has more to do with the change in the asset allocation. Private debt had also a very good year, around 12% return. But also interestingly is when you look at the risk figures and the volatility figures, you will also see differences here. Infrastructure has only analyzed volatility of around 12%, whereas private equity has a significant higher volatility of around 18%. So this is important to have in mind. Also, when we look later on the long-term performance of those asset classes, it's very important to understand the risk and return characteristics. Otherwise, an investor might be disappointed when allocating investments into those asset classes. The question is, how do we come up with the benchmark? I think this is an important question because typically investors don't think much about it because for traditional asset classes, be it equities, cash, fixed income, or real estate, as an example, you have existing benchmarks and everybody knows them, uses them on a daily basis. For global stocks, it's the MSCI World. For US stocks, you use the S&P 500. For German stocks, you use the DAX index and so on. However, for private equity or for alternative assets in general, it's not that easy. That's also why we launched our index in 2004. However, investors still have a challenge when they would like to know how did my investment in alternative assets compare to the general market. So how can I judge whether the manager who is responsible for this allocation made a good job or a bad job? So that's why we launched our indices. And when you launch an index, when you launch a benchmark, it has to fulfill some criteria. Typically, it's called the Bailey benchmark criteria. That are 5 criteria that have to be fulfilled. Otherwise, it's difficult to establish a benchmark. It has to be unambiguous, measurable, appropriate, specified in advance, and investable. Typically, for a standard index, for standard benchmark, nobody questions this. For the MSCI World, it's clear that's a measurable index which is specified in advance. It's also clear that it's investable, and so on. However, to have an index that is measuring the performance of alternative investments, the index or benchmark has to fulfill the same criteria. Otherwise, you cannot compare to other benchmarks. So how did we come up with our benchmarks? And I will start with private equity. Here you see the filter that we apply to come up with the benchmark. Again, this is not rocket science, but someone has to do it. So you have to analyze the market of private equity companies. And what we do in this case, we focus on private equity companies that are listed on the stock exchange. There are around 120 companies on a global basis. And the criteria really is to look whether those companies that are in general are investment companies, whether they have, for example, an exit strategy, whether they have a management team that is able to make private equity investments. So someone has really to screen those companies and to make an assessment and then define a base universe of private equity companies. And then we apply liquidity criteria in order to have an index that is also investable, because as you remember, this is one of the key criteria in order to have a benchmark. It has to be investable. So we apply liquidity criteria. We look at the market cap, at the free float, at the trading volume, and so on, and then construct also so-called LPX indices. Again, that are indices that are composed of companies, private equity companies that are listed on the stock exchange, but that have a business model which is investing into unquoted companies. But I will show you some examples later on. So now when we have those stock market indices, we call it the market price indices based on the stock price performance of listed private equity companies. In addition to that, every private equity company that is listed on the stock exchange also has to publish in so-called NAV, a net asset value. And the net asset value is measuring the underlying investment portfolio of those private equity companies. And then we also have a premium discount index, because when you compare the market price with the underlying net asset value, you either have a premium or a discount. So we can also provide premium discount indices. But today I would like to focus on the market price and the net asset value indices, because they can be used either to compare the performance of private equity with other asset classes, or you can use the net asset value indices to analyze the underlying investment portfolio and compare the performance of those private equity stocks with the performance of typical closed and unquoted private equity funds. So for every user, for every use case, we have the data that can be used for measuring risk and return, either for investors that are exposed to the market, or for investors that are exposed to unquoted, unlisted private equity funds. Here you see some of our indices for the market price-based indices, for the equity index series, and for the fundamental index series, which is based on the NAV of those companies. We have global indices, we have style indices, we have 3 categories that we measure, and we have also 3 regions which we measure. So for each of those indices, we then have an equity index and we have a net asset value index. So we are always able to measure, on the one hand side, the stock price performance, and on the other side, the investment portfolio performance. And now when we start looking at the performance over the past 30 years for private equity, this is now going back to 1994, and using our LPX50 index, which is a global private equity index. And here you see the stock price performance of private equity stocks on a global scale. You see, of course, that some macro events also had an influence and hit the performance of private equity companies. It started with the dot-com crisis in 2000, 2001. It was more a venture thing because venture capital companies were hit at that time. We had the financial crisis 2008, 2009. This was more a buyout problem that we saw at that time because many buyouts were financed with a high degree of leverage. So what we saw then in 2009 was a deleveraging process. Then we had Fukushima, we had Euro crisis, Corona 2020. Now we have a Ukraine crisis. So there's always something that is hitting the market. However, private equity on the long term had a very positive performance, and especially when you compare this to global stocks, which we'll also show you later on, we see a strong outperformance of private equity in general when we look at the return figures. Here you see an annualized return of around 8.8% since 1994. And over the past 10 years, we had a return of around 11% on an annualized basis. So private equity tends to outperform global stock markets. The question is now, how much is the outperformance? But before I show you that, here you see the same chart, but in a different scale. Here you see the normal scale that we are used to, and this is showing the log scale. So here it doesn't show that drastically, especially over the past couple of years. So I always recommend when you look at the performance over the long term, especially when it's more than 10, 15 or 20 years, it always helps to analyze the return or the graphs when using the log chart. As I mentioned, to measure the return characteristics for private equity, we use our LPX50 index, which includes the 50 largest private equity stocks on a global basis. And here you see some of the investment and portfolio characteristics. It's always interesting to see that by constructing a benchmark, it's easily possible to have a diversified portfolio, in this case of private equity investments. You see here the distribution across vintage years, and also the distribution across sectors. We use here the GICS codes. So you have a diversified portfolio, and that's also why we think the index is representative for the private equity market in general when you are invested in a diversified portfolio. Of course, when you're invested just in 1 or 2 vintage years, or just or in case you have a sector bias, then a broadly diversified index might not be the right benchmark. However, for every investor that has a diversified portfolio within private equity in general, you can easily use that index as a benchmark. Now, when we have a look at the so-called NAV indices, the net asset value indices, which are measuring the underlying investment portfolio, and just to give you a better understanding how this works, typically, when you look at the portfolio of an LP structure, a limited partner structure, you have an investment portfolio, which is invested via the limited partnership. And then you have a fair value. Also, those investments are valued on a regular basis, not on a daily basis, but usually at least once per quarter. You get an update of the fair value. The same is true also for companies that are listed on the stock exchange. when you look at the private equity companies that are listed on the stock exchange, they also have to provide a fair value of their investment portfolio. The advantage is the data is much more standardized and maintained on a regular basis. Because a company that is listed on a stock exchange has to fulfill much stricter criteria and has also much better governance compared to typical P structure. That's why we think by extracting the data from listed private equity companies, we have a higher data quality and can use that data to measure the performance of private equity in general. And we do this on a continuous basis. So every time there's an update on the investment portfolio, we include that in our database. So we don't wait for the next annual or quarterly report. Whenever there's a news coming out, it is reflected in our database. And here to give you an example how this works, here you see the NAV reporting. The gray line shows the official NAVs for each quarter, and the turquoise line shows then between those quarters, it can always happen that there is an event. It can be a trade sale, it can be an IPO, it can be a write-down, a revaluation, recapitalization. So a lot of things can happen between the official reporting dates. And because the companies are listed, they have to report those events. And again, this is then included in our database, and that's why we are able to produce a daily update on the investment portfolio and are able to measure risk and return also on the investment portfolio. So not only of the stock price performance, but also on the investment portfolio on a daily basis. And this is now showing you the return not of the stock price index of the listed private equity stocks, but of the underlying investment portfolio, the underlying net asset value. This is going back to 2003. So in this case, we have roughly 20 years of performance data. And here we have a return of around 8% since 2003 on an annualized basis. This year, we have roughly 6% return in 2023. And again, not to be confused here, this is the NAV, the underlying investment portfolio. And this can directly be compared to any diversified exposure to private equity via unlisted funds. So our clients typically use this in order to measure the performance of a GP or a fund manager that is managing an investment into closed and private equity. And then an investor knows how does this compare to my the broad market. And as we have seen, it is a diversified portfolio. It's a global portfolio measured in euros in this case, based on the 50 largest listed private equity stocks. Here we compared also this return, so the NAV return, to the data set of another data provider that is measuring only unlisted private equity funds, and we come up with a very high correlation of more than 0.8. So again, we are convinced that our data is representative for measuring not only the stock price, but also the underlying investment portfolio of private equity investments. So now coming back to the performance of private equity in general. As I mentioned at the beginning, within private equity, there are several sub-segments, and it's important to analyze also the sub-segments of private equity, especially buyout and venture, because we see significant differences when looking at the underlying performance of those two sub-segments. And I would like to guide you through some of those performance characteristics. Now again, let's start with 2023. Here you see the performance of those two sub-segments, buyout and venture. As you can see, buyout returned in 2023 around 7.8%, and venture returned, so now up to date, it's around minus 7%. So the figure here that you can see is already outdated. It's -7% year to date. So again, between buyout and venture, we see significant differences. And the question is what reason for this difference in the performance current classes or those two subsegments of private equity? I think this is mainly due to the change in the interest rate environment. Venture, as you probably know, the valuation of venture capital investments is mainly future cash flows discounted by a discount rate, which includes the risk-free rate. And the risk-free rate, as everybody knows, went up from almost 0% to 5% in US dollars. So this means that future cash flows are discounted at a much higher rate than it was the case 2 years ago. And this is especially an issue for venture capital investments because the valuation of those investments mainly is based on future cash flows, because typically you don't have an existing business model where you have positive cash flow. Today, you expect positive cash flows in the future. So in the changing interest rate environment is especially an impact on venture capital investment and a less impact on buyout investments, because in buyout investments, we talk about investments in existing companies which have a track record, which are cash flow positive, where you would like to grow in new markets, in new countries. So in this case, you can base the valuation on EBITDA multiples or other earnings multiples, and the valuation is less dependent on future cash flows. So that's why we see this dispersion between buyout and venture, especially this year. This was also the case last year in 2021. So the question is, what will happen when the interest rate environment changes again, or maybe when the expectation, as we see it now, is that the interest rates will not go up much further up. So I think interest rate is an important performance driver, especially for venture capital. Whereas in buyout, the performance drivers are really the IPO environment or EBITDA growth, or whether you have a network that can help you to grow your company. And here, private equity again plays a very important role. Again, this is important for investors to have this in mind. Again, buyout, venture capital are branded as private equity, are branded as alternative investments. However, when you look at the underlying investment characteristics, you see significant differences. Now, comparing the stock price index with the investment, or the NAV index, which is measuring the investment portfolio. You see here the blue line, which is measuring the stock price, and the gray line, which is measuring the underlying investment portfolio. And of course, the stock price is either above or below the net asset value. So you either have a premium or a discount. And as I mentioned at the beginning, we also measure this and have an index that is only measuring the premium discount of those stocks. And this is displayed here, the premium discount index for the LPX50 index. And currently we are at a level of around 20%, which is at a very low level. When looking at the past 10 years, you will realize we were almost always at a discount. The exception was 2018. Beginning of 2018, and exception was also end of 2019, we had a slight premium. And before 2007, before the financial crisis, we had premiums of up to 20% on average. Now we are at a discount of 20% on average, which means some stocks trade at a discount of around 40 to 50%. So the question is, where does the market go in the next coming years? Typically, when we look at the past 20 years, it was usually the case when you had this degree of discount, you could always expect a very strong outperformance of private equity against the general market. So let's see what happens in the next coming years. But when we look at the underlying investment portfolio, we see a very positive development. And we also see that those companies are typically valuing their investments very conservatively. So again, this is another tool that investors can use when analyzing the performance of private equity stocks and whether they would like to know where we stand in the market. And this data is also updated on a daily basis. Now let's switch to the next asset class, infrastructure. And as we have seen at the beginning, infrastructure returned -6%, so completely different picture. And the question is now, how do we define infrastructure? I think that's important to mention before I show you some of the long-term performance characteristics. I think it's important to have in mind how we define infrastructure, because everybody has a different understanding of infrastructure. But I make it very, very short. We focus on core infrastructure companies. Core infrastructure companies means companies in those three sectors: energy, transport, water, and communication. And within those four categories, within those three sectors, we really focus on the core infrastructure companies. To give you an example, in the energy sector, we focus on grid line companies, on pipeline companies, on general distribution networks. But we exclude all those companies that produce power, for example, because a power producing company needs an infrastructure. They need the grid lines. And this is what gives you the risk and return characteristics an investor is looking for when investing into infrastructure. Producing power is much more volatile. You have much more competition compared to a grid line company. Within the transport sector, for example, airports would be included, but we would exclude airlines. In the communication sector, we include satellites, tower companies, but we would exclude everything that, for example, typically a Vodafone company or company that is providing communication services to the end consumer. We focus on companies that provide, in this case, tower companies, which provide towers to the communication companies. So a very strict definition of infrastructure. And by doing so, we are also sure that we have only companies included here which have a very stable cash flow and which have also a monopoly position within their sector. And to give you one example, Transurban Group, that's a toll road company in Australia. What we do here, we look at the reporting of the revenues, and we only include companies that have then revenues coming from the provision of that basic or core infrastructure. And in addition to that, we also look at the relation revenues. So we also check whether the revenues are regulated or not. This gives another data point for investors that, for example, would like to have a bias towards companies in the infrastructure space that are highly regulated, because it gives an additional factor when analyzing those companies. And also when we look at the market of infrastructure, and that's why we also think a listed infrastructure index can be used as a proxy for measuring the infrastructure market. Most of the infrastructure companies are listed. Of course, there are unlisted infrastructure funds. However, when you look at the number of companies or number of investment vehicles, and also at the market capitalization, which is roughly $4 trillion, that's much. Market share it's much higher compared to unlisted, which has roughly $1.2 trillion. So listed infrastructure is a huge market. And that's also why it's much more easier to construct an index in this regard compared to private equity. You see some of the characteristics when looking at the universe of those roughly 400 companies. It's a global universe, diversified again across regions and sectors. And when we look now at the risk and return characteristics, this is now our broad infrastructure index compared to the S&P Global Property Index and to the MSCI World Index. Now going back for the 299, we have here now roughly 24 years of performance data. Infrastructure returned 8.6% on an annualized basis over that time frame. And again, here you see the linear chart and below the logs chart in order to have especially when it goes back that far, to have a better understanding on the characteristics of the investment. MSCI World during the same time period returned around 6%. So you could expect an outperformance of roughly 1.5% every year of infrastructure compared to global stocks. And this then compounds over the years, as you can see here. Again, as said already, this year infrastructure had a return of -6%, and the main performance driver for the negative performance this year is mainly due to the shift in the asset allocation by many institutional investors. So it has nothing to do with the underlying investment characteristics or economics. As you can see here, when you think about those companies, an airport, a water distribution company, a tower company, their business models are very stable, healthy. They have stable cash flows. Also, when you look at the inflation rate currently, those companies are able to pass on the inflation to the end consumer because they have a monopoly position. Because usually when you have a grid line company or a toll road company, it doesn't make sense to build a second grid line just to charge lower fees or to make competition to the existing one. It only makes sense when there is need, when there's a need for a second or an additional grid line or toll road, but it doesn't make sense from a competition perspective. However, they are regulated by the governments, but and that's the case all over the world. Usually, they are able to pass on the inflation rate to the user of the infrastructure facility. And here in Transurban Group, you see here a short extract from the toll, from the concession contract by the government. And what you can see here is that they are always able to pass on the inflation rate to the user of the infrastructure. So you have an inherent inflation hedge within the infrastructure space when focusing on core infrastructure companies. That's also why we are not concerned about the performance this year, and we are quite optimistic for the coming years for the infrastructure asset class in general. So the last asset class I would like to discuss today is private debt. So we have roughly 10 minutes left. And again, here we are focusing on companies that are listed on the stock exchange but provide debt capital to unquoted companies. And it's a growth market, especially when you look over the past 20 or 30 years. The market share of the credit market by non-banks has increased dramatically. So now more than 90% of the credit market is serviced by non-banks. I think this is incredible, and this will continue in the coming years. And the question is now, how can investor participate, first of all, at this growth, and then also the underlying characteristics of direct lending or private debt in general. When we look at the yields over the past 6 to 8 years, you see here three lines. You see the yield of leveraged loan yields. You see US corporate high yields, and we compare this to the yield provided by direct lending companies that are listed on the stock exchange. And of course, this is linked to the investment rate environment in general, because those rates or yields that are charged by those companies are typically linked to the LIBOR index. So direct lending yields now around 10%. This is slightly higher than compared to corporate high yield bond index. However, when you look at the underlying ratings, we have on average a higher rating in the companies included in our direct lending index. When we look at the yield of the LIBOR, as mentioned, typically this is linked to the LIBOR index, so we don't have a duration in the portfolio. When the LIBOR goes up, the yield goes up, and it has no effect on the nominal value, and because there is no duration within the debt portfolio. Typically, there are some exceptions, but you don't realize this in the performance because it's diversified, and in 90% of the cases, it's a floating rate. So when we look at the performance of those companies, this unfortunately we don't have that long history. It goes back to 2009, because before 2009 there were simply not enough companies listed on the stock exchange that provide debt capital. It's a growing market over the past 10 to 15 years. But nevertheless, we have data going back to 2009. And during this time period, direct lending companies, private debt providing companies returned around 10% on an annualized basis compared to the MSCI financials of around 6.7%. So again, here private debt outperformed global stock market index. But more interestingly, when it comes to direct lending, is the yield. And here you see the yield for this time period, so going back to 2009 for every year. So over the past 14 years, we had a yield of 7.8% at the lowest and 10.9% at the highest in 2009. Now we are around at 10% yield. But the nice thing is that you can expect from those companies, a yearly yield that is interesting. And the yield is basically based on interest rate payments by the companies that get the debt capital from those debt providing companies. So the underlying economics is really private debt. Also, when you look at the investment portfolio across industry sectors and also across the collaterals, more than 50% is first line or senior debt in the portfolio. More than 20% is IT, information technology in the portfolio. So again, here you have a diversified portfolio across industry sectors with a bias towards senior and first line debt. And as mentioned, the index goes back to 2009, and the credit volume aggregated here is around $110 billion based on more than 4,000 loans. I have to mention there is a bias to the US, so most of the companies that provide debt capital and are listed on the stock exchange are listed in the US. So that's maybe important to have this in mind when looking at the performance. Also have in mind that the performance here is measured in US dollars. So that are the the three asset classes that I wanted to cover. To sum this up, I would like to have again a quick look at the performance drivers and what you can expect for the coming years. And I'll repeat myself, but I think it's important to have this in mind. Alternative assets include several sub-segments, sub-asset classes, and it's very important to have this in mind when you look at the performance drivers, be it interest rates, the IPO environment, future trend investments, or the inflation. Inflation and interest rates have hit venture capital investments significantly over the past 2 years, but the effect on buyout investments was much lower compared to venture capital. Whereas in infrastructure, as I mentioned, there's an inflation hedge within those companies because they can pass on higher prices to the end consumer. So the inflation has a less effect on infrastructure stocks compared to private equity or venture capital in this case. So it's really important to have those three asset classes in mind. Of course, there are other sub-segments within the alternative investment space, but I would want to focus on those three asset classes because we see that are the most important ones, and we also see from our clients most questions and interest comes to those three asset classes. But it's important to have in mind, what performance drivers will be in the coming years. In general, we are quite positive for alternative investments, for private equity, for infrastructure, and also for private debt. Venture capital is you can expect a higher volatility in the coming years, especially when it comes to interest rate changes or inflation changes. This will be much more volatile within the venture capital space, but I think that's something investors should not be surprised of. In the buyout market, it's especially important to have a look at the IPO environment. And this again then depends on the general stock market development. Yeah, so this to sum this up, alternative investments I think will play a more important role in the coming years. What we've seen in the last 12 to 18 months was really that investors needed to reallocate because of the change in the interest rate environment. But once this once those investments have been made, I think alternative assets will play again a very important role in the asset allocation. And personally, I'm quite optimistic for the coming years. So now I'm at the end of this webinar. So let me thank you for your attention, for your interest. And in case you have any question or whether something was unclear or you would like to have more information on the various indices, on our benchmarks, or on our data and research that we provide, please feel free to contact me directly, call me, or write me an email. And again, thank you very much, and I will look forward to our next webinar in the new year. Thank you.